All right. We're going to keep this as simple as possible. As always, that has become pretty much the recurring theme no matter what's going on. I use that word simple or simplicity a lot because it's not very complex. I'm not a big fan of doing a lot of market prep to begin with, to be honest. And, it's not because I feel like you don't benefit from it, but really, there's so many swings in price and things that happen in the after hour session and all that. To me, that requires a little bit of improvisation. And so, you can't really marry too many ideas. But that said, we're at an interesting point in time in the market, and there are several different things that have taken place over the last few months that make me believe that, we're getting closer to a more tradable market, if that makes sense. It's not the fact that the market hasn't provided trading opportunities. It absolutely has, in both directions. But I do think we're at the height of this inflection point between all variables. It'll never get more interesting than it is right now. That means volatility, that means range. I can go down the list of things that I find beneficial. But, all in all, I think this is a really great opportunity or a great time for traders to lock in. I'm going to go through some setups and talk about my approach to the market. I'm giving people a few minutes to get in and settle in. This stream is a little bit more of a surprise one. It's going to lay the groundwork for the future because you're going to find me streaming a lot more or back to the levels that I was at in previous years. I've been testing the waters, getting the groundwork together for how I want to approach this market within Discord. But I know there's a lot of people out there who say they benefit from the kind of commentary or whatever it is that they feel I bring to the market. I'm just giving you my perspective. So in a few minutes, we're going to start. In the chat, you can actually, wherever you're watching this from, because we are now streaming to multiple places at once, but wherever you're watching it from, if you comment, I'll probably see it. It's best to comment on X or Twitter if you want to share a chart or get some feedback or some information or share your thoughts. Also, if you guys are in Telegram and or Discord, feel free to let me know what the streaming quality, audio levels are, that kind of thing, so we can make adjustments as needed. But I'm going to start with SPY. Or maybe we should start with the macro picture. Let's talk about the calendar itself. Calendar is pretty important, for what we have coming up. We can't ignore, we can't miss where things are and how things are on a broader scale. It'll be nice to ignore most of this stuff and just move straight to, I guess, the way I'd put it is charts only. That ain't the case, and that's probably not going to happen until you probably got a couple more years of that, or the way things are right now, which is fine. But all in all, I think this is really important. So let's start with 14, 15. Nothing to worry about here. Tuesday, nothing to worry about here. Wednesday, you already know. It's going to be Kevin Warsh's first press conference. Volatility, all that stuff. Yep, pretty cool. The usual Thursday routine. Jobless claims come in. No one really cares. People complain about it. And then no trading on Friday for equities, as it is Juneteenth. So a short week. That's the first thing that I'm thinking of. We got a short week coming up. What else can we really do or pay attention to in that regard? So that's the first thing. The second thing would be, what do we think about short weeks? Short weeks to me mean at times less volatile price action, but that also means less liquidity, less level to level trading. That's not a bad thing. It just means keep that in mind. You might have some suppressed moves at times. Now, to talk about the other side of that, deal or no deal. That's one. That'll induce some volatility as well, or has the potential to. So I'm keeping all those things in mind. I'm thinking to myself, well, if I've got to deal with all of these things, I probably want to be very technical about my levels. And then remember, the most important thing is to trade based off of my risk rules, my position sizing, etc. Don't really try to predict or forecast the future. Instead, I would focus on how to make the best decisions possible given the information that I have at the time. And that's it, and just go from there. As far as on whether or not a deal happens, I mean, look, go read up on what's going on right now. And in addition to that, I would say, remember that the market can't predict what's going to happen or how the response is going to be. It could be a sell the news event. Remember, this isn't an actual peace deal either that's being proposed. It is an extension for further talks to happen. However the market feels about that, I don't know. My job isn't to predict that. I couldn't care less. I don't have a crystal ball, and I'm not going to pretend to have one. But I will say that I think that has the potential to increase the volatility a little bit more going into tomorrow. Futures will tell, but the reason I wanted to do this prior to the futures market opening is because I think that can skew your opinion or your views of things dramatically, maybe more than it should. That's always been my approach. I want to get the most basic levels and setups out of the way first. All right, so I'll also dive in here real quick and see implied volatility for, I mean, we know what tomorrow looks like, but on a day-to-day basis for the tools that I use, I'll come in here and I'll chart this, a little bit later most of the time, but let's see what Thursday looks like. 17.72%. So obviously that's taking into account the Fed rate decision that I'm going to go over here. I'm going to plug this in. And then let's go take a look at the closing price from Friday. Closing price 742.45. $742.45, 17.72%. That's not that surprising. It is a little bit it's a little high. It's a little elevated. Maybe not for the situation. I expect this number to fluctuate, and not only that, this back and forth between Iran and Axios is getting out of hand. They're at a spot now where you got one side saying one thing, and then 20 minutes later, you got the other side saying something else. It has never been this bad. The ping pong back and forth between those things, it's never been this bad. So because it's never been this bad, I think regardless of what happens, the market is going to end up in a little bit of a frenzy. And you can spin it however you want, but this number is going to fluctuate, and I think it's going to increase, especially not knowing what Kevin Warsh is going to say and or do. If I had to take a guess, plug your ears if you don't want unsolicited opinions. But if I had to take a guess, it would be go watch my video on Kevin Warsh's history. My view on it, though, would be, or my guess on it would be, he is going to follow more of what Powell has done. Remember, Powell's still on the board. And I think that is both because of the investigation, but also as a precautionary measure. And he's expressed some concerns about the Fed being taken over and becoming political. So his thumb is on the scale, essentially. And if his thumb is on the scale, I could see rates staying exactly where they are. It's that simple. The situation is too delicate to start making moves right now. Not only that, the bond market has not flooded to the point where I feel we'll see a spike, or we have seen enough of a sustained spike in yields. If you don't know how that works, bonds go down, yields go up. You flood the bond market. It means nobody wants the treasuries, especially long duration, 30-year. And when the bond market is flooded, government's got to coerce you to buy more of that garbage at that time, the government debt. And if that's the case, you'll see those yields spike. That's the risk-free rate. If the risk-free rate is high, then you're going to find a lot of those long duration stocks get hit up first. Why is that a big deal? That's really simple. Trading these names like the Mag 7, this is risky outside of Apple pretty much. It's risk. If I can get 5% year over year plus my premium paid, or my principal, I can get that back. Doesn't make sense for me to invest into something that's a lot more aggressive or a lot more dangerous, a lot riskier. The caveat there, though, is that the most recent treasury auction, well, it didn't go so well. The next 30-year will be more telling, but the most recent 30-year pretty much told us that the market is a little apprehensive to purchase government debt as well. So where is the money going? They don't want the government debt, and they've also sold out of some equities, although this isn't a lot given the rally, and then especially if we zoom out all the way. But if there is some apprehension, what's really going on? Well, I think a lot of the market is waiting for the Fed chair to say, hey, we're going to raise rates, keep them the same, or in the very unlikely event, hike rates. I'm not really too concerned about any of that. But the point is, the market is still at a bit of an impasse. Not to mention, there's a decoupling from the oil pricing as well as the broader economic picture. So in other words, people are experiencing higher costs. That's reflected in everyday life. Those who make up the 90% of equities held, or who truly control the market dynamics, I don't think they're impacted the same way. So this is more just a pause in what we've seen. So we can call this this pullback in the rally. Don't get me wrong, it's aggressive, but I don't think we're at a spot where we should start making determinations about the future just yet. If I had to sum all that up in a couple of sentences, it'd be very simple. The markets saw the rally, hated the rally. I talked about that for the last couple of months. I traded most of this to the upside. I'll take my day trades to the downside. I love that. I love the opportunity. These were some pretty crazy candles. It was enough to give the market pause. But as far as volatility goes, that should be expected. We are entering into a time of uncertainty. And I don't think Donald Trump has helped with stability in the market, because while he has been consistent about what he says, he's getting a lot of pushback from the media and the other side of that trade and transaction. And he's kicked the can down the road so many times that we really don't know what the reality is or what's going to happen. So I keep all those things in mind. Now let's move on to the chart itself. Daily chart. There's a lot of lines. I'm sure you guys know you usually don't see this many lines on my chart, but this is mostly for when I'm trading and sharing or teaching, trying to give some insight for some others to understand my process a little bit better. Rangefinder, pressure rails, that's what we're going to use for now. I'll end up changing them tomorrow depending on where the market opens, but for the time being, let's take our range. $8.22. All right. 750.67. Let's say 734.23. As you can see, the range hasn't shifted too much. I'm going to put an asterisk next to this, just as a reminder to myself. This is coming from, actually, that's not even gonna. To me, that makes a lot of sense. That's probably the best way to go about doing it, simply because the more I spell it wrong. The more I look at the market and understand where we've come from and where we have the potential to go, the more I become convinced that much of the market is playing it by ear. So even early positioning, it's not going to give you the strongest read, but these are very important because it tells us at Friday's close, this is how the market priced those options. This is how the market foresaw the day-to-day range going into the next week. I guess it makes sense for us to go ahead and use that tomorrow's price as well. Those are monthly contracts, 615 for tomorrow, 14.78%. Let's do it. Why not? Anchor rail 749.31, and let's throw 735.59. Oh yeah, that range is gonna start getting pretty interesting. Now we can't change the live rail until the market opens tomorrow, but we'll come back to that. Also, for the sake of just going through the process the usual way, I'm going to go ahead and get rid of these lines. We don't need them right now. I probably should not have gotten rid of that one, but we can redraw it. That's going to be a really important point. We can get rid of this as well. All right, broader picture, top-down analysis. You already know how I do this. We don't even need the 4-hour chart, but I would like to put this into perspective for some people. As you know, we have come from a long way down. We are way up. Great. The market has faced some rejections on multiple time frames. In fact, I'll even do you one better. I'll give you the weekly chart, and we'll turn all the drawings off for the time being. What do we see? Pretty simple. If we wanted to add something to the chart, we'd say, all right, we closed above the lows from previous weeks. It's pretty good. Broke down for a little bit. It closed within that balance, this box, if you will, this area. Is this important? Maybe. I mean, this continues to help me reiterate the same point, that we haven't gone anywhere, essentially. So I would start there. Market is at a point of indecision. That is the first point I'd make. Now we can put the drawings back on. I'm just going to do this the easy way. I would say, have your notebook generally and jot down whatever so you can remember it. That's the first thing. Market is at a spot of indecision. All right, cool. What else we got? We got volatility remains elevated. Yep. We got those two things going on with it as well. Third thing, I don't want to talk about imbalances or anything like that. I got to bring volume into the picture just because I'd like for us to have a really good understanding of where we've come from and where we have the potential to go. I'm going to use visible range, and I'll make this point one more time. I've said this in this, what I've posted on X. I've said many times, you can rally on low volume. So let's get rid of this idea that this needs to correct. I've said this so many times, it's crazy. On screen, visible range, most of the volume is here. It is true. It is true, but that's just because the market spent all this time here. The move up still had a decent amount of participation, but you might be noticing a bit of a trend here. When the market starts to sell, it sells aggressively because the market has already been trending up. It's convinced that it's over. You get a lot of people trying to buy the dip because they're convinced it's going to continue. When you see low volume, there's just a lot of guesswork. A lot of people are afraid to commit to one side or another. Plus, rallies can continue at this point because you're not getting aggressive action. You're not getting aggressive buying and selling all the time or the entire way. What you're actually getting on the long side are market participants who it takes time to buy. There's a difference between buying and buying aggressively. So maybe they're buying and they're just taking their time, but they don't want to be too aggressive about it. They're not chasing it up. And this doesn't even get into the option side of things. But my point is, all in all, this is a valid move. It doesn't need any kind of correction. I think you might save yourself a headache if you accept that what has happened doesn't need to be corrected or retraced, as I've been saying for the last couple of months. Now that we can accept that and we've arrived here, now I think we can go into the monthly chart, and now we can go into the 65-minute, which I like to use. Let's make sure that does that the right way. There we go. Now we've got a better picture on the month, this is perfect. The entire month has shown us what? We're trading down. Don't believe me? Go to a monthly chart. That's the red candle. That's why you got that there. 65-minute chart. We're back. And what do you know? Up here, this has been a pretty consistent area for several rejections. I'd like to draw your attention to this move from 2 Fridays ago. Very dramatic stuff. Here's how I view it. Always tell the story of the market, right? So this is a major move down. Fantastic. And also, I'm not going to forget about how the rangefinder rails continue to operate as levels of support or places that we revisit, but that's another story for another time. The market sells off dramatically. This is intraday selling. This is crazy. Makes another move in the pre-market session or after-hour session, gets rejected in the regular session. Higher volume. I'm not going to call that higher conviction, but that's higher volume. I would not discredit that. The futures market may help things move a certain way, but what's happening intraday? Those are the questions I would ask. And then I would also ask, what is forcing those moves to happen? You cannot say that it was a deal that was not signed or some sort of headline that tanked the market. That would be inaccurate. The same thing here. You cannot say that there was some sort of headline. In fact, on this Friday, you even had Trump make comments that you would think would boost the market. Strong jobs report. He even said himself, the market should go up. Okay, so what does that tell me? Well, I've said this before, but his ability to keep the market afloat is one thing. But his ability to pump the market on pure speculation, or his word, so to speak, I believe has been neutralized in some capacity. This is a really important piece because all you got to do is lift the signal from the noise. The signal is that, yeah, while there's a bunch of headlines flying around, the market is starting to call him out and say, hey, this is the guy who cried wolf, so to speak. Right? Like, we're not buying into your lies, yada yada. Whatever you think about them, this is not political commentary. I'm just speaking to what the market has responded to. So he tried that. It didn't work. Also, a strong jobs report. Why is the market tanking on that? I think there's some volatility dynamics at play, and I think the market has been preparing for this Fed speech or this rate decision coming up with Kevin Warsh. You don't know what to expect. That's higher volatility. So go back to your daily charts. And if you have your notes, I'll just put that up there. Volatility remains elevated. And we put, I'll put those two there. I mean, 2 is a cause and effect relationship. 3 is the reason you have 2, but it's not the only reason. All right, so we go back. What's the next thing? From a chart perspective, again, after hour session up, regular session down. After hour session up, regular session down. And both times extremely aggressively. And it became a runaway train. Now, the market did recover some of this move. It's true. But after hour session, down. After hour session up, regular session, down. I mean, come on. This is very important stuff. Not to mention the break of this low, but we can forget that for now. Then you get a Hail Mary headline. You get one. You get a really good one. You get the SpaceX IPO, whatever. To me, that brings this area into question. If no deal is signed, especially, I have to pay attention to all of this. I can't ignore any of this as much as I would like to. I would love to go back to trading just on, I'd like the charts. I'd prefer not to have to deal with the macro environment so much. But anyway, the character of the market has been very aggressive to the downside. Not only that, in the regular session, we have seen aggressive selling. We have not seen aggressive buying. We have not seen strong, sustained moves. Got a couple of candles here. I got no problem with that. This is cool. But Friday, even with all the reports that there's going to be a deal signed over the weekend, market did not respond to that the way it had the day before. I'd argue that the market dynamics in general shifted price, and Trump just may have contributed a bit of a match to gasoline that was being laid here. But I do not believe that that is directional, or that the market is accepting that something positive is going to happen. To the contrary, I think the market has become very pessimistic about these things, if not completely disengaged or uninvolved from that narrative. So I keep that in mind as well. Not to mention, as I've said before, this is a really important point. You don't know how the market is going to respond to a deal or no deal. So I think it is a fool's errand to try and predict that. Once again, the job isn't about having a crystal ball. The job is to take all the information we've discussed just now and say, all right, here are the facts. Here's what we can prove. And then let's look at the technical picture or the structure and then go from there. And then see if we can tilt the probability in our favor, try to capitalize on it, and account for variance and say, this might not work. If it doesn't work, all right, cool. Let's move on to the next thing. So if I had to sum all this up, the market is not giving the benefit of the doubt to this administration anymore. We have gotten some strong recoveries, but let's not forget this is on the heels of a pretty large downside move, and you still haven't cleared this level. So now let's draw some additional levels. I'm going to keep this red box here because I don't think you need a singular price. I don't use singular prices. I use ranges. When the volatility expands, you want to use ranges, not singular prices. Okay, so why am I doing it this way? Price could easily gap up here, could hover around here. You can get one strong candle and price can make that move there. And then you get, whether it's stopped out of your trade or you change your views and you go long, and then you realize, oh, wait a minute, the market hasn't actually cleared that level or that area for long enough for price to make a decision from that point. Maybe one order gets transacted up there, maybe a few different orders, maybe even spend 15 minutes there. When people say it needs a 5-minute candle close or a 15-minute candle close, that's wishful thinking. That is all cherry picking. What's the difference between a 5-minute candle and a 7-minute candle? Absolutely nothing. It's 2 minutes. That's it. There's no rule. There's no law that says a candle closing above a certain spot means anything. The only time I would make that concession would be on a weekly and a daily chart. Maybe. And even then, this is a really good example. Look at your screen. Right here, there is an area of resistance. Price breaks above here for how long? This is a 65-minute chart. This means it spent several minutes above that pre-market high. And what happened? Absolutely nothing. It faded down the rest of the day. This chart here, same thing. Above the previous day's high and its pre-market high. This is a 65-minute candle, so we can infer or deduce even that it may have spent 5, 10, 15 minutes above this. And if you went long, you would have absolutely gotten smoked. This is why I don't put any faith in individual candles. You may increase your probability on the smallest time frames. If you're scalping, okay, great. Even that's risky. But the general area hasn't been cleared. That's what needs to happen. It's that simple. So if you want to go back to your chart or go back to your notes, you could put, all right, the market is at a point of resistance. I put, despite the recovery, the market is at an inflection point. It needs to prove it. That's all it is. That's what's happening right now. The market needs to prove it. It needs to prove that it can recover this If you question the validity of this area, I would say, all right, well, back out of this a little bit more and pay attention and say, all right, yeah, this has been resistance in the past. This is not just some random level. It's not arbitrarily chosen. It has been an issue for the market in the past, even right here. Ceilings and floors, folks. So I'm not quick to make a determination on direction until I see what happens here, essentially. Not to mention, the majority of the volume on the week is traded right up here. That is both the aggressive selling from this candle, as well as the market not moving or refusing to move pretty much all day on Friday. But let's not forget, the market did, at one point, prior to the headline or the announcement of a deal being signed, this did break down, and it was pretty aggressive. And we'll come back to that in a second. Before I start charting or plotting individual lines there, I'm going to get rid of all the singular lines on the Qs for a very important point. This has led the market continually. The Qs have led the market. So, I guess we can make some notes here. Usually I won't draw this stuff on my chart. I don't have a problem remembering this. There you go. This might be the single most important piece to all of it. QQQ has led SPY. What does that mean? Well, it didn't clear this. This is the pivot that it needed to clear, and it hasn't done so. Not good. Not good. If you're trying to change your focus in the market, you need to remember that there is somewhat of a phantom ceiling. There is still a ceiling, a lid on this recovery. Yeah, it's real great that it recovered this area. That's cool and all, although it may have been built on something that doesn't actually come to fruition. When I look at this, I realize that, man, you know what? If I had to pick a singular spot, it would be here. I don't like that that hasn't happened yet. And until that happens, whether it breaks through and retests first, whatever, it needs to clear that. Q is led SPY, and there you go. That's how I'm looking at it. It's led SPY, and it needs to clear that pivot, this general area. That's just the reality. You might not like it, but it absolutely does need to get through that. Tech in general needs to. Why? Because if we start going around the rest of the market and we look at Microsoft, you can realize the market leaders, the things that have gotten SPY to this point to begin with, or SPX to this point, they're not very strong. And additionally, Nvidia has also seen similar weakness and failed to recover. This is easy stuff. This is basic stuff. Google also is terrible. These are some bad looking charts. So all in all, I'd be very careful with running with this narrative that the market weakness, and I'll actually add this to my notes, I'd be careful with that market weakness point that it's all because there was no deal, and now that there's a deal, we're back to where we were. We're back to rallying. Yes, love it. Yeah, I mean, go through my tweets from the past month or my posts from the last 2 months. I've been saying, first, the market doesn't have to break down. I've been saying that. I also said, hey, stop fighting it. You know, and the market's been rallying or whatever else. The market doesn't care. I've said that many times. It's true. I don't think the war is as big of a factor as people think it is. So I'd add, consider that market weakness is not from the war, and definitely not the SpaceX IPO. Pretty important points. If I had to put all that together, I'd say, yeah, we're not out of the woods yet. Things are still kind of messed up. They are. It's okay to look at the market and say, maybe I'll trade this to the upside, but there's still some issues at hand. I really do think you can save yourself a lot of headache if you approach the market from that perspective. I'm being purely objective here. All right, now we can actually talk about some price targets or whatever else. Another thing I talk about with the increased volatility or that range, this is the same chart as the Qs. This is no different. It's just there is a spot that has not been cleared. You see why I use this box? But this is the same thing. Yes, you could easily go back and say, man, we're finally recovering. Everything's great now. Everything's fantastic now. It would completely ignore the broader context. This is why you do top-down analysis. So when I look at this and I say, yep, this was a pretty cool couple of candles. It was. This is not a good day. It isn't. This is pretty much sideways with some increased volatility and some increased range. That is it. Going into a week full of potentially highly volatile setups or a volatile environment. So yeah, there's a lid on the market. All right, cool. Let's talk about some individual prices. 746.90 is at the price the market needs to clear at minimum. Yes, and if I went into another chart, I would go in and say, hey, yes, what do you got for me? And I'd zoom out to that. No, we can use a 15-minute chart, it's fine, whatever. And I'd say the picture is exactly the same here. And then I'd also say, even though I know it's the Dow that is the actual key here, let's look at SPX. And you'll see I have this blue box here. Why do I have that here? Because 2 Fridays ago when the market was breaking down, I kept saying, this is that area of support. This is that spot you need to watch, yada, 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 whatever. Market broke down further from there. This is the area that needs to be reclaimed. It is ceilings and floors, people. Until that is taken care of, I would not be making those kinds of determinations. Additionally, and I would also say, this is a really important piece. Even if the market gaps up, deal, no deal, who cares? You know, Donald Trump jumps into the octagon and knocks Gaethje out and everyone rallies. Knicks won the NBA Finals. Great. All those things. It could be the most amazing thing ever. An eagle soars down and there's a rainbow and money starts falling from the sky, and you know what I mean? Come on. It can be the most American, patriotic, bullish thing ever. We're never going down again. Market can gap up. And if it doesn't hold this area convincingly, you're cooked. You can already see how this has happened once before. So in other words, pump your brakes, friends. So I would go back here to the daily chart and I'd say, all right, consider the market weakness is not from the war. That's a really good point. And then I'd also add let someone else go first. That's all. It's just that's got to be cleared. The reason I'm telling this market story this way is because you can use this going forward, and you probably should, actually. This is how it is. This is how it has to be. But it also means that, let's say there's some market weakness in the price action. And SPY isn't clearing this 746.90, and the Qs aren't clearing this, whatever this price is. Let's 725.66, and SPX isn't clearing 7483.15. Okay. Could that give you the space to anticipate a downside move? Well, that's what I did on, was that Tuesday? Something like that. On Monday, I traded to the upside. And as you can see, it faded lower, and I added to my trade at a couple spots. And I said, all right, we haven't broken the previous days, whatever. Price action was whatever. Okay. We gapped up, made a nice high early in the day. Early in the day, I closed that trade out. I took my win, and I traded short. Boom. Crazy. One of the best trades of the year. However, it all came from the same thing I'm telling you right now. It isn't what people wanted to hear. Right? The market was convinced that there was a full-on recovery. I was convinced that we might be recovering because this was such a major move, and that's why I traded long on this day. Once we revisited this and I saw that we were getting these rejections, I realized the opportunity. So the price action is going to be the key thing to watch at that spot. And I'll find a way to make this a little bit simpler, but this is the last piece. 7 steps. Price action, patience, anticipation, extremes. What do I mean by extremes? On my chart, you probably have noticed I have something here that says trade the extremes or trade extremes. To me, this just means it's similar to let someone else go first, but it's really about waiting until a larger, crazier move has happened, or when something has moved outside of its range. I don't trade level to level, range bound trades. Instead, what I look for is what has been happening in recent areas. And then once I've gotten a chance to see that, I wait for the market to get a little more aggressive, so to speak. Do the thing that the market isn't really expecting. Wait until things get really crazy. Then, instead of joining in, assess whether or not that's strong or weak. I'm just going to come back to this as an example really quickly, because it'll help you frame or understand my approach for it this week. You see how this isn't really a dramatic move? The market just faded a little bit. It faded. It wasn't crazy. It took all day for that to happen. Then we get the gap up. Cool. Even make a move higher early. Excellent. On this day, I wrote about this. You can go read it. But I said, if the market pulls back here, I would love to trade this to the upside, get some continuation, maybe retrace some of this move. That was the plan. Price action made it pretty clear that wasn't happening. So I traded short. Now you know my general philosophy or thought process going into this week. I'm bringing this up because this was the extreme. It was above the pre-market high, the previous day's high. It made a new high of day. It was above any pivot you could really place over here. A lot of the market got cooked, which is why a lot of the thought process or the activity and the anticipation, the energy for the week ended up being deflated outside of the SpaceX IPO. This was the thing that did it. This is also a really good time to say, look, stay consistent. Don't focus on your performance as a trader. Don't allow that to dictate whether or not you show up every day. That is the mark of a trader who won't make it. Show up every day, same energy every day. I've said this before. It's going to sound harsh. I have a hard time respecting people who don't approach the market the same way every time, or approach anything that they say they want to be good at with the same energy every time. Every time. Approach it with gratitude. Approach it with a level of focus and clarity and say, maybe it didn't go my way this time, but I'm going to show up again because I'm going to get those opportunities. You got to believe. This is also a good time to say, I know people have, I'm already getting DMs about this. I can see your DMs. I will message you later. Yes, you can join the Discord and Telegram. Or you send me a DM. You're not gonna be able to go through the link because I don't want people signing up blindly. You can join us. You just send me a DM on X. Nowhere else, just there. You don't have to give me some long spiel about your trading history, and no, you don't need to be an experienced trader. You can be a beginner. That's fine. Or you can be starting over. But this is the best way to approach it. All right, so we got one level. We got 746.90. That's cool. 15-minute chart. Obviously, and I really don't want to get rid of this box here, but maybe we can just make it smaller. How about that? I'm only going to do the level to level thing because I know that some people probably prefer it and it helps them see things a certain way. But trust me when I tell you, if you would just commit to using ranges, rectangles, as opposed to singular prices, you'll probably have a better time. All right, so we'll just for my own, my personal taste here. There you go. Yeah, obviously previous days high, cool, whatever. Don't really care too much about that. When the pre-market shows up, we'll make some adjustments there. previous day's low. There you go. As you can see, they line up really nicely with the rangefinder, and that's the site that I created, or the company that I created versus the market has these kinds of tools. The rangefinder is one of the tools. This is actually the thing I use the most, and it does some amazing things with price. All right, so we got those two. Here's my approach. Early in the day, I'm going to be looking for price to, if it breaks out, right? If price breaks out and does something amazing, I don't want to say I'm looking to short it, but it needs to clear this area first. Otherwise, most likely, if price is flirting with this, I'd be looking for one of two things: either a retest of this previous day's high. So on your lines, stay high. Look for a retest here to go long. This means you need price to break out above it and whatever the pre-market high is at the time. So let's just be clear. This is the previous day's high. Look for break of PMH, which is pre-market high. Above pivot, which is 746.90. And retest here. To consider going long. That's a lot of information, but we're not talking about chump change. I mean, trading is a serious business for me. I'm talking about real money. That might seem like a lot, but you start seeing these people post, hey, this is all I had to do whatever. Like, all right. This is not a knock on anybody trading pennies, but this is a great business. This is a very valuable thing to be able to do. We need to treat it with the same level of care and respect, right? We need to give it the attention that it deserves. So that might seem like a lot, but once you do this for a while, this begins to make sense. So we need a break of whatever the pre-market high ends up being, a break above, or break of the above pivot, which is here. Let's just go ahead and label it pivot, and a retest here to consider going long. That is it. That is the intraday plan. Notice how I don't really care too much about what happens with the deal, or I'm not trying to forecast what Kevin Warsh is going to say. I'm not trying to forecast anything outside of what I'm going to consider doing if these other things happen. Let's talk about the other side of that trade, right? So I got some good entries on Friday. One of them was from near the peak. So I have some short exposure going into the week. That doesn't really change my bias. If the market starts, going crazy and this happens, I'll close out that trade and I will go long. It's the same thing I did over here, except for the market went the way that I wanted it to start the day off, and then I pivoted. The short side of the trade. If the market is not, let's say it breaks above the previous day's high, which would be cool. Let's say it does that. But then let's also say it can't clear this area and it gets rejected from here a lot. That's all going to be price action dependent. And so I'm going to add that here. Pivot. Price action here is key. Short opportunities or continuation. And actually, it's kind of redundant to put continuation here because that's what the green line is. So we'll keep it simple. Price action here is key to look for short opportunities. I would not blindly short. This is a huge determining. This is something you have to use a lot of. What's the word we want to use here? You'll need to use a lot of discretion at this spot and discernment. It's not very black and white. It's not very cut and dry. Very dangerous. Much riskier than attempting to trade the trend. The only difference though is that the trend is to me this marked more of a top than anything else for this range. 65-minute chart will help explain what I'm talking about. This is ugly. This is terrible. This does not look good. That is what I'm saying. Therefore, the way everything traded on Friday, I'd be a little cautious of, for sure. I wouldn't be so quick to call this a regular trend, even if I turn the after-hour session off. This is all right. This is fine. You can call it a bull flag if you want to. Ignore the context. But all in all, before I go trading short into it, I would, especially when it's broken the previous day's high and pre-market high and whatever else, that's a difficult trade. It's one that really requires a certain level of risk rules. That's it. You don't know how it's going to go. All right, so we got that pivot. What's next? The other scenario that could happen. Let's say the market breaks down first. Okay. I can work with that pretty easily. This is probably my least favorite scenario because it takes us away from trading the extremes and it takes me more into trading equilibrium and trading from a place of balance. So I feel like most traders would have less of an edge here. However, again, I don't have a problem with doing it, but I really don't want to see the market return to any of this and hang out here at all. The only thing that I could say would be, we'll take a line, we'll place it here, and we'll say, this is a pivot, sure. And I'll go ahead and, my color coding system might be a little strange for some of you, but the general idea, and to me, this is, honestly, I don't like it. I'm going to call this no man's land. If the market returns here first, you're pretty much looking at needing a much stronger directional trade. What I mean by that is, if the market returns here, it needs to make decisions and you're back in the chop zone. So instead of no man's land, we'll call it chop zone. Avoid making decisions based on whatever happens here. I don't like it. 740, you can call it a mental pivot if you want to, that's fine, but the last thing you want to do is get caught up in whatever was going on here on Friday. So if the market gaps down, breaks down, hangs out around here, anywhere, does anything similar to what I'm describing, I would not be, for instance, I would not trade short if the market breaks down here first and doesn't clear its pivots, if it doesn't clear that previous day's low. So that means on the previous day low, much like I did with the previous day's high, look for a break of the pre-market low. And let's be accurate here. So a break of the pre-market low. So let's say that's, for instance, let's say it ends up being 738.12. That's the pre-market low. And the market breaks down through that. Okay, great. And then it approaches this previous day's low here. Then I keep that in mind. I would look and see, how did it trade around that pre-market low? How did it trade around here? Because that makes it a candidate for the bounce. Not to mention the anchor rail that I have here. So I'll actually add that as well. Instead of look for the break of the pre-market low, we'll also add come back to it and add something else in a second. So we'll look for the break of the pre-market low. We'll look how it traded here. Basically, be careful of the bounce. Even if the market gaps down or breaks down or fades into any of this, this comes back to the same thing. Price action is key here to look for opportunities, and I would even add bounces are dangerous here. Also, you might notice I have this random box here. This has been here for a long time. It has a question mark on it. And I'm pretty sure I first drew this, even though you can't see it on these other time frames. I'm pretty sure I drew this somewhere in May. My point is, though, it's my least favorite scenario because it takes away that extreme. It takes away a strong move for me to go short from. And most importantly, it's an area where you really need strong price action, I think, to substantiate or solidify any additional short trade. It's just a dangerous move. So I don't like it. So that would be my ideal scenario. Price gaps up or at least fades or breaks out in some capacity. When I say fades, I mean, price can fade to the upside, but let's use some terminology that's probably a little more universal. If we start the day off a little bit higher, but not with strong price action, then I've got a couple areas where I feel like I can set the trap and maybe trade it short. Now, I will consider what has happened on the global scale, or whether or not there's a deal, whatever. Trump or whoever, Axios, at any point in time could come out and say, I know we didn't get the deal done yesterday, but actually it's going to happen maybe Thursday. That's how it's been. They've kicked the can down the road constantly. A bunch of things can happen. But the likelihood of price breaking out above this and then continuing higher in a very strong fashion is lower than the probability of price breaking down and then bouncing. That is why I said trading the extremes here, to me, is the real opportunity. Next. That's the plan, actually. I mean, that's the general idea. And let's see if I have that in my notes now. Price action, patient, anticipation, extremes. I'm going to put bias here. Bias, looking for bull traps. That is the general theme and idea for this. The other thing I'd like to see, if we were going to trade a bounce, let's say there's strong activity. If the market misses, let's say there's a gap down. If the market misses its pre-market low and doesn't break the previous day's low, then absolutely I would likely consider trading it to the upside. That's the general theme here. So really, we don't even have to say traps. If we don't want to get into a bias, you could actually just say patience for traps on both sides. Or on either side. And I think the fact that we've had such a wide range makes this a lot easier. Instead of bias, I'll just put strategy. Patience for traps on either side. How long do I wait for those traps? Could be 15 minutes, could be 30 minutes into the open. Depends on what happens. The further we go into the day, the less likely those traps are to happen. I really like to see those kinds of early moves happen in the first 30 minutes. 15 minutes even. See that? Just as an example. That wasn't really a trap. This is one. Breakout, breakdown. Cool. Same thing here. First 15 minutes, break out, break higher, 30 minutes, down. First hour, breakdown. Nice trap. Took an hour. So I'd give it the first 30 minutes if I can. I'd give it the first 15 minutes if I can, before making a determination. Lastly, for SPY. So we got look for break of the pre-market low. The anchor rail bounces are dangerous here, and we can probably be a little clearer here when I say that. Careful of shorting into the hole. If the market is showing you it's not looking for that, it's not willing to commit to that downside move. Let's say the market's not really giving you a lot of aggressive downside activity. You got to respect it. You got to be really careful of this area. That's just my view on it. The only way I trade short from here is if we break those levels I just talked about and we get some maybe more aggressive momentum. But at that point, your risk to reward is, it's removed significantly. It would have been a lot better had the market break, or if the market were to break out and you could go short from up here somewhere. All right, that is SPY in a nutshell. Later, I may post these charts again. This is the kind of the analysis that I do in the mornings during my live streams anyway, which are in Discord. So for some of you that are watching, if you're in Discord, if you're in Telegram, that'd be a good time to tune in. And also, we are back to recording those live streams so that you can watch them back if you miss them. Cues. We could argue the same type of thing. Only thing I can say here, though, is that my analysis is going to be a lot faster for these names. We don't need this. We don't need this. Let's get some clean charts in place. The Qs have led SPY. Qs need to clear that pivot. Oh, actually, you know, we should add that. Let's go back over here and let's just make sure we... let's see. Despite the recovery, the market is at an inflection point. Prove it. Weakness. Let someone else go first. Yeah. Let's also add patience for trap on either side and look to QQQ and Mag 7 just as a reminder. And then what you can do is, you see I have price action over everything always on my chart. We can lock that in place. That is the strategy for the week here on the Qs. I think we've seen increased moves and increased volatility, but what I'm actually going to do here is I'm going to go just like I did with SPY and just figure out what the market is pricing in for tech. 615 23.86. I mean, we're seeing a lot of the realized volatility, so it's not just implied. That is something. That's no joke. I wouldn't be surprised to see these numbers increase in the morning, depending on what happens today. So we're going to go daily chart. We're going to find the previous day's close, or the close here. 723.25. So weird even saying that. That sounds wrong, but yeah, that is what it is. Range nearly $11. We're in a different market. 712.46. All right, so what's what I'm gonna do? Make two of these. Put one of them here. 712.46. There you go. 734.04. All right. Let's actually move them over. This is our range. So far, this is the range the market is pricing in for tomorrow. And as you can see, actually you cannot see it because it is original time frame only. Let's change that real quick. 734.04. All right. There we go. All time frames. And let's lock that in place. And 712.46. Yep. Easy. And let's also change this. All time frames, and let's lock it in place. Great. I ain't got to do that again. All right, what are we looking at here? I'll actually move this on over to the spot as well. That's your range, friends. That is your range. Not that significant of a move compared to what we have seen in the past, but it should, at least the way I see it, when it comes to purchasing options, especially, and even in trying to understand the kind of range that the market is priced in, which is the true definition of how this works. This is not any different than what we've been seeing over the past week. So, same thing when it comes to setting the trap. If the market is hanging out around here and not even clearing any of this range, 68% confidence, 1 standard deviation. This tells me that the market has a 68% chance, essentially, of covering at least one move, either that 8-point move to the downside, or is that 10 points? 11-point move to the upside or to the downside. Interesting. So when I start to notice the market is trading at a bit of a ceiling here somewhere, that tells me there's a really good chance that either we stay pinned here or we can fully retrace that move or get that larger move to the downside. I mean, again, this is literally the exact same strategy that I use for whatever day this was, and same thing for here. So I'd keep that in mind. I think we'd also be remiss if we didn't go see what the market thinks about, or what options dealers think about tech after the Fed meeting. 28%. Got it. $13-point move, 736.22. So this is what I'm going to do. Come here. I'm going to make another one. $17.28. So you can see the range is a bit wider. Let's lock them in place. All right. That's a pretty wide range. And like I said, when the market opens, I'll see what, I'll calculate the live rail, which is that blue line that you usually see on my chart. Same strategy, same plan. Only thing is I'm looking at the Qs and thinking this might be a little more volatile, and I can look at the composition of how tech has been moving anyway. And I still have no confidence in Nvidia. I have zero confidence in Microsoft. These are the other things that I would consider headwinds for the market. So let's actually go one more time for SPY and put, I already have looked to the Qs and Mag 7, but it's really about figuring out where those headwinds and tailwinds are coming from. So I actually don't need to add anything else to it. The Qs are the same. I probably wouldn't trade this name personally, but it's the exact same strategy if you favor the Qs as opposed to SPY. I feel like I have to talk about Tesla because it has it is in the conversation again. From a setup standpoint, you're trading in a range. This is just trading in a range. That is it. It is also hit by too many other variables where I feel like if I wanted to chart a setup or if I wanted to trade this, it's really simple. You got 400 as a pivot, the same pivot that's been here. I've kept these are older pressure rails, but it has remained the same. Everything comes down to this inflection point. I would not day trade this. I know others do, but for me, I don't find any more of an edge here than with anything else. But just for the hell of it, since we're online, let's do it. I don't need the rails to be too up to date. All I want to do is make sure that there is no major change in the implied volatility, or at least the volatility itself that's realized, so that we don't think Tesla is trading in any crazy fashion relative to how it has been. I think that's a really important piece here. Earnings coming up in July, so we're clear there. Look at that. IV of 58%. You guys are nuts. You gotta be crazy. Doesn't matter. Let's do it anyway. And 46% historic realized. That's a lot of that move. So not bad. It means if you're paying for those large moves, the market is moving in a large fashion over the last 30 days. So maybe not the worst idea, but I'm going to use the monthly expiration. 618. Let's go look at that price from the close. $406.10. $420.85, and for Tesla, you already know why that's a funny number. It's a recurring joke, the longest running market joke outside of Jim Cramer being the easiest inverse signal. But let's do it anyway. $391.35. Range is expanded. That's the monthly contract range, or basically Thursday's expiration on the options. So, as you can see, price is trading dead in the middle of it. That is it. If I wanted to try and get a better picture of how I would trade this, I would need to go into a much smaller time frame to figure this out. I would actually use the same strategy here. Because it's so volatile, you don't really know, but it has built a decent amount of a base. This is actually pretty close to what we see in the Qs and everything else. Only difference here, though, is that upside range that you have here. The same thing applies. You just need to clear significantly more space before you start making any decisions. And I mean, that includes all of this. That is a pretty wide range. So it's actually the same strategy. This would be the goal. So I would use the exact same approach. If the market pulls back first, I observe and see if it's bouncing at an area of not really support, but if you can find an inflection point for the market, you could use volume if you want to. I'm here to tell you not to rain on your parade, but this stuff doesn't matter. It really doesn't. The market can move without it. But if you need a point of confluence, you can say, yeah, a lot of volume traded here on Friday, so if price were to pull back here but not break through its pre-market lows, and obviously it's not going to break through its previous day low unless we get a crazy gap down, then there's a really good chance that somewhere in this 401 to, I'd even say this little gap here, this 400 area, that's where I'd be looking for that bounce if price seems like it's averse to trading into this gap. So let's go ahead and mark it since we're here. I don't think we need to mark this stuff, but let's do it. Previous day's high. Bounce area. This would be the spot. Potential bounce. Original time frame. Extend right. All time frames. There you go. Potential bounce area. Watch for tests and retests. I would not short above this unless we got a much higher move here. Previous day's high. Of course, you want to see where the pre-market low ends up. Although, I'm not so, I would not be so concerned with that. 400 as a mental pivot is just dangerous anyway. I would not be shorting beyond that. Let the market give you the extremes. You're starting to notice most likely a recurring theme in my thought process here. So those are the only two levels I would really use in this environment, in this situation. And then, of course, like I said, I'd be careful of both of these spots. 412 as a pivot, but just this general range to begin with as far as an exit spot. Could it be really that easy? The answer is yes. You're dealing with a lot of variables right now and increased volatility. All right, now we've done the Tesla thing. Now let's go look at this meta reversal that everyone keeps trying to trade. I'm not touching this. Let's move on. Never trust Apple. Ever. Is the worst stock. Stay away from it. If you're investing, that's one thing, but I don't trade Apple, as you may already know. Microsoft, same thing. I would stay away from names that are trying to find the bottom, especially names that could not rally or were unable to participate in recent market recoveries. I also would not trade them short. These are just names that you stay away from while the market is figuring that out. Nvidia, this would be fun. That activity, that price action, I feel like Nvidia is moving or moves SPY in a pretty considerable fashion often. So the way that I would do this, once again, I would just go take a quick look. You don't have to dive into it too much, but I would take a look and see how this is moving. Let's go look at that implied volatility. Also, this is, before I get off stream, this is your opportunity to, if you have charts or you have names, I haven't looked at my notifications, but if you have names that you would like me to take a look at, shoot me a message. Or actually, don't message me. My DMs are already out of control. Maybe mention me or tag me in the post, and I'm happy to take a look at what you guys are trading, and I'll also run a scanner real quick and see what else is out there. Nvidia has been pretty important, but have you noticed something? One of the things that's keeping the market from being able to rally and sustain any kind of momentum is it's missing one of its biggest players. It's missing one of its most important pieces right now. That's what's happening. That's what happens when you get the sector rotation, and it's not even a complete rotation. It is moving from chips to software. The market is very much at a pause, at a standstill. That's all you got to think about here. The market is still trying to figure some things out. AMD can do it, but AMD is not Nvidia. This is late cycle behavior, so I'd be careful of that. But let's go look at the implied volatility. It's not that exciting. Everything's boring again with Nvidia. Yeah, it's not interested. Without volatility, you have no range. You end up trading in this choppy garbage. That's what's been going on. So once again, staying away from it, but remembering that this happening has implications for this guy over here. Another reason I do not like the idea of the market continuing currently. It's very simple stuff, man. And then lastly, I don't think I need to go into or dive into Google currently, but here's my idea, or here's my thought process. The more names we can see face this same kind of activity, the more of a push all of it needs, the more aggressive the market needs to get with its upside narrative. And I think that's why, even though I don't know that we've seen the market top for the year, I mean, I've said before in the chat or in the Discord or whatever, Telegram, I've been saying I think we see at least another high sometime this year. I just think currently it's not great. And it's also funny that the market is at my call writing to raise cash note that I've talked about or I've kept on my chart. This has been a market high or a pivot in the past. The cards are feeling stacked a little bit against continuation. That's all. IWM, another name. So this one at an all-time high. Let's try a different strategy here for a second. How do we approach an all-time high? Well, since SPY isn't there, let's talk about IWM. Got the after-hours session on. Cool. We can go into the range and see what the market is pricing in. And I kind of like this idea because it gives you an opportunity, or it gives you some exposure. It gives you a way to look at something a little differently than how the rest of the market is moving. So it's worth looking at. Historic and implied volatility are both also on par with each other. Not bad, pretty cool. Even though, even the monthly or that Thursday expiration, same thing, not too high above what we've seen. Not bad, actually worth adding. I would make the argument that this increase here is also due to capital rotating and trying to find where to go. So if I had to put it in the simplest terms, the market is aware. The market is self-aware. It knows what's going on. It knows that, hey, things are kind of high and the vibes are not as high as they once were, especially not around here. So if the vibes are not as strong and the market is trying to recover, how do we avoid this dead cat bounce? And I think the market is afraid of those two things. It's afraid of things running and continuing without them. But I think they're also aware that there might be opportunities elsewhere. So it isn't a complete market sell-off or sell the news event or whatever phrases you might have heard. I don't think the market thinks that it's the end of the world. No matter what bad news you throw at it, not so much. But if you convince them just enough, they'll take it and run with it. So where's that money going? I think small caps is definitely part of that. Although, yeah, I'll save my judgments on small caps in general for another time. But let's get a couple of these up here first. If you end up using any of the levels or the strategy or the thought process that I'm using, let me know. That'd be helpful, actually, because I will consider doing more of these for the public. Everybody trades differently. Everybody does things differently. So, I'm giving you guys a pretty surface level or a pretty easy way to grasp what it is that I'm doing. It's not for everybody, but if it's helping you, then maybe we'll continue. All right, we got closing price $293.59. Such a cheat code, it's ridiculous. Implied $288.67. All time frames, lock figure. All time frames, lock figure. There we go. That's your range for this upcoming short week for IWM. The next thing, this is so easy, it's ridiculous. Actually, I need to move IWM maybe closer to the top of my charts that I'm looking at here so I don't forget. This is actually looking, to me, this looks a lot better than even what I see with SPY, mostly because of the way that it has traded and because it has already cleared those important pivots we talked about. You know how everything else is kind of like at a recent high or just underneath a high prior to those large moves down? Well, this is trading above that. Doesn't have so much overhead to deal with. So I definitely prefer. I like this if I wanted to trade to the upside and I wanted to deal with a little less. If I needed to do less thinking and wanted to just trade level to level. Pre-market high or previous day's high. We don't have the pre-market high currently, but when we get that, it's something we can consider. So there you go. We got 2 levels to clear. Pretty easy stuff. Of course, the consideration would be, actually, we don't even need this chart. What I would put here is previous day's high. Easy. As far as the downside move, I'd be a little careful with just shorting because, but you understand the thought process or the strategy. Now, if price is missing the pre-market high and misses this, just put the inverse is also true. So if price is hanging out up here, same thing, doing what, the SPY and the Qs might be doing, maybe I'd consider it. As far as upside targets go, hello, that's what that's for. You don't have to look any further. If you want to use some other tools, if we just want to Just want to have fun with it. All right. Swing low, swing high. Whatever. There you go. I don't take Fibonacci levels seriously. Don't get mad at me. Easy. Not the worst opportunity or setup in the world. And like I said before, I really like that it has cleared a lot of this. If I just had a short bias in the broader market, I would really also like this as an opportunity short, just because it has cleared these levels and it is the highest currently out of everything else. It's already broken through those levels. So if it starts facing some resistance here, some pressure here, you also have some pretty clear targets, which would be, previous day's low, which was a prior ceiling, and maybe some continuation there. I don't like messing around with the small caps too much, but the general idea here is a little bit cleaner than all the things we got to consider when we're talking about a larger index and one that's impacted by the macroeconomic picture. All right, before we wrap this up, scanner. I think I already had. I haven't done this in a long time, but we'll do it anyway. I have a scanner built for this. This is actually a pretty easy one. PEDXing, or the SP's attention seeker scanner. Yeah, this is a good one. I can see from these names I'd probably stay away from most of them that Disney set up. Actually, I've been looking at for a little while. It's not ready yet. Not ready yet. The risk to reward, not great. It needs to truly bottom and needs to find a spot where it can actually do that. It hasn't done that yet, unfortunately. What's the other one? Nike, I think. Close. Not quite ready. Don't like how it's trading. Yeah, not ready. Not there yet. Let's try this one. The PEDXing scanner. It's been such a long time. Such a long time. All right, so crossover, 13 EMA, got it. Hammers and falling wedges, cool. Apple. You already know I don't trade that. AMD, too close to its ceiling for me to want to trade it, and also it is a name that has, how do I put this? I think it has benefited from the market not really knowing what to do with the money that they had in NVIDIA, just to be honest. ARM, I would also, personally, I'm going to stay away from. It had a really nice move the last couple of days. Not quite ready for that one. I don't like any of these. The TSM trade, yep. Oof, similar, not quite ready. I got a better idea. I'll just go to SMH. If I had to take a name that had a little bit more of a headwinds situation going on, meaning similar to SPY, similar to the Qs, but maybe with a little less positive momentum or positive upside, it would probably be SMH, and I would actually use it the same way that I've done with everything else. I would go here and I would say, all right, let's try and figure out what that volatility looks like. Because this sector, this index, this name, this ETF, probably has the most to lose from things rapidly changing in the macroeconomic picture. It has led a lot of the market, but also these moves were extremely aggressive, even relative to SPY. This These were very aggressive moves. And the thing to remember, if we were to go to looking at that 30-year yield, as I said in the video, yeah, right now it doesn't look that bad. We've seen worse. But nearing 5.2%, and then the treasury market having a poor auction, that's a telltale sign. There is something under the hood. There is some pretty considerable fear. I think most of it is uncertainty around how the rate conversation will go. But if that's the case, and I got to continue to point this out, if that's the case, the names that stand to lose the most are the ones that are long duration. Nvidia is a prime example, right? You are relying on forward-looking cash, forward-looking value. Tesla is another one, but you're looking for SpaceX. Don't even get me started on that. Not a dollar made. Not a dollar made. No profit. No profit whatsoever. Just valuations and vibes. And that's cool. I got no problem with that. But why do I think that's important? The market is already showing you that risk isn't really the concern from a returns level. The market is not as concerned about what it's going to get in return. The risk-free rate was at 5.2% or 5.1 something during the auction. The market is concerned about money in a different fashion. So maybe they're not quite willing to say, yeah, the world is ending and I want to buy government debt. We don't even know what the government debt picture is going to look like. We don't know if Kevin Warsh is going to flood the bond market to begin with. We don't know if he's going to cut rates or not. So instead of going where the steep end of the curve in terms of risk is, instead of going off the deep end and saying, yep, we got to go bonds instead of stocks, the market has actually moved into other areas in the risk curve and saying, maybe we can find value somewhere else. We're not quite ready to go to treasuries yet. We're not quite ready for that. But maybe things are a little bit more muted in the growth part of things. And if you think that growth itself is going to take a big hit, especially in the semis, that's why you look at SMH, because it has the chance to have the longer trade and the strongest moves. Remember, the S&P has 502 companies, so it's going to get some residual tailwinds regardless. SMH, maybe not so much. Even the Qs, maybe not so much. That's why I think, again, SPY is a little more balanced. The implied volatility might not show you that right now, but that's something I would keep an eye on. Let's move on to this next part. 58.48%. I mean, this is crazy. Let's look at that close. Also, for most of you guys, if you've I'm on my other screen, I'm looking at the DMs I have up here now. One of the questions is, do you stream? Yeah, I do stream every day. I stream every morning every trade morning at the market open. And this other question that we got. I appreciate the question. If you are still in here, you can see for yourself. So the roadmap, for instance, or even like the videos. Yeah, I have a lot of the videos and live streams are saved here. We're revamping it to where, I mean, it's a lot of content, but as I said before, you can search through the content by using the keywords. And so in the past, when I have talked about volatility, because I know I'm talking about it a lot now, you haven't heard me say a lot about it, or I haven't gone into depth. There are enough examples. I mean, I've talked about volatility hundreds of times, so you can find all that stuff within the site. And for people that are in the Discord and the Telegram, you get access to this automatically. Thanks for the question. Again, the point is not to be vague when talking about it, but it's just, again, we're just trying to get the setups and everything going for this upcoming week. Volatility, especially, is a conversation that would just take a lot to discuss, a lot to talk about, or to try and provide value when discussing it. It's a broad topic. It takes time. All right, close here, 621.84. And I'd actually consider trading this. Maybe a little bit more than IWM, actually. For people in the Telegram and the Discord, yeah, I will also I will post these charts in there with a brief write-up, but I'll also go a little bit more into detail about my process, or what I'm planning for this upcoming week. That always strikes my curiosity. That always piques my curiosity, and grabs my attention. When I see any part of the range near a major pivot. 599.11, all right. That's your range there, and you got some actual, some pretty serious recent resistance, some pretty serious pivots overhead. Cannot ignore that. If you just feel more comfortable with levels, easy money. One of these is that previous day's high. 62, 24, 62. Yep, it's this one. There it is. I don't want to say go short above this or at this area, but can't ignore it, man. It's just being honest. You really got these two entire areas to focus on here. I can't even use that pivot, or I can't even place that there. Let's try. Oof, terrible. Yeah, we're just using a red rectangle. To hell with it. This is where it is. You have to pay attention to this area. There is resistance hanging overhead after what I would call a questionable Friday. It might break through that previous day's high. I would honestly be looking for this entire area to become a sort of resistance here. And even if there is some positive momentum from SPY and wherever else, I would be very careful of this. That is dangerous. That's fine. We'll keep it. I'm going to leave it alone for now because I probably won't trade this. I'll most likely just trade SPY. But that said, I'm telling you, man, the key phrase here is phantom ceiling. No matter what happens, no matter what news comes out, no matter what anybody tells you, I think everybody should keep that in mind. There is something hanging over the head of the market. And if you buy the, no pun intended, if you buy the narrative that the market traded to the downside, simply for the fact that there was no deal announced or whatever, just go back to Friday. Just recall how you felt not last Friday, but 2 Fridays ago. Out of nowhere, the SPY is falling. I love that phrase. Should put that on a shirt. You know, the general consensus was, what the hell is going on here? What happened? How did this happen? This is ridiculous, right? I would think about, well, this doesn't matter. I would think about what happened, and I would say to myself, I would come back to these charts and think there was something going on, and it is not geopolitical necessarily. Notice how we didn't even talk about the macroeconomic side of things. We talked about news and headlines. We didn't talk about the implications that rates are higher, inflation is higher. Rates are higher, and when I say rates, I should phrase this a little differently. Rates have not been cut yet, if they are going to be cut. Inflation is higher. Oil is higher. The yield is higher. The yield auction, the bond auction, despite the high yields, did not leave any confidence, or it does not inspire any confidence. Not only that, deal or no deal, we don't know how the market is going to react to it, and there is still a 50-50 chance that it is a sell the news event, not to mention there is no deal. And even this extension of peace, if it goes through, if it's true, whatever, the market still has to contend with the fact that you don't know how things are going to play out long term. The only caveat to that downside thesis, or this overhead ceiling thesis, is that you got midterms coming up. I know Trump says he doesn't care about midterms, but I still don't think the plan is to tank the market going into it. It would be, I think that'd be very interesting. It'd be unprecedented. I also don't think that Kevin Warsh comes in and wants to be Volcker, wants to be a hawk, because all it's going to do is cause infighting with, it's not really infighting, it's an independent institution. The Federal Reserve back to fighting with the President of the United States, or having words in what is really a one-sided argument where Trump continues to spew, hurl insults at the Fed. Maybe that happens, but if it does, that also is not very great for the market. And let's not forget about the tariff situation. Yeah, that did not go away, by the way. So can we get some pumps above these prices? Yes, but I'm exercising caution. That is going to do it for this stream. I think, again, if you find this stuff helpful, let me know, or you can comment on the post or on social media somewhere. If you're watching this on Twitch and YouTube, or wherever you're watching it from, X, you will probably find that I'm going to be streaming more often, but we probably won't go as in depth. I try to save that stuff, or this kind of stuff, for people who understand my methodology and my thought process, and for those that are waiting on the trading roadmap and all that other stuff. It is very complete, very extensive. I released 2 additional steps to the roadmap over the weekend. Most people probably didn't realize that, but there are even more on the way. So if you want to learn, or if you want to improve your trading in some capacity, or just listen to me ramble about the market and my thoughts on the market, send me the DM, because like I said before, you cannot join through the link currently, and we'll get back to you this week. And that's it. Enjoy the rest of your weekend, and whatever crazy headlines and stunts happen, make sure you turn notifications on X so you don't miss my posts, because I will follow up on these kinds of things. And if you're in the Discord and Telegram, you can expect me to post these charts with some additional commentary and entries and that kind of thing. My plan for the week on Wax. Thanks for joining in, and I will see you guys next time.